businesses, small businesses that actually take loans out are going to actually be in this mixed into this mess. I honestly think there should be a benchmark rate for small businesses that are proving, or they could prove that they're actually hiring Canadian employees and blah blah blah. You know, people legal to be in Canada, and they're actually hiring them, putting them on payroll. They should get a lower rate, and this could create a government incentive to create more business in Canada. And this would be great. And then this way you have another rate for consumer borrowing, whether it's housing, whether you want to buy a car or something. Then there should be a separate rate across the board to protect the people, so that small businesses don't have to take the brunt of rate hikes when they're, like I said, employing and contributing to especially the private sector. You know what I'm saying? So central bank benchmark pushes up borrowing costs for consumers. This was posted 2 hours ago. The Bank of Canada has raised its benchmark interest rate by a quarter point for the 5th time since last summer, pushing up the cost of borrowing for Canadians. The bank's rate is now set at 1.7%. That's the highest it's been in almost a decade, dating back to December 2008. Remember, guys, historical lows, historical interest rate lows, not good. Creates these bubbles, it becomes more attractive for foreign investors to come in and pop up or buy up existing stock. Known as the target for overnight rates, the benchmark is what Canada's big banks charge each other for short-term loans. It filters down to consumers because it affects the rates the banks offer their customers for things like variable rate mortgages and saving accounts. So Bank of Canada isn't making too much, but the banks, some of the posted rates are right now at 4.55%. So it gives a little bit of middleman work for the banks. Remember, middleman, a banking system or a federal banking system the banking system basically is the middleman, is what it is in this case here. It filters down to consumers because it affects the rates the banks offer their customers for things like variable rate mortgages and savings accounts. That's really happening. As four of Canada's biggest bank increased their prime rates by a quarter percentage point on Wednesday, which is today. The Royal Bank, TD, BMO, and CIBC have all raised their prime lending rates from 3.7% to 3.95%. Scotiabank is expecting to follow suit soon, but all new prime rates will be in effect as of Thursday morning. Canada's central bank has kept interest rates at record lows for several years to stimulate the economy following by the economic slowdown in 2008, but has since begun to ratchet it higher as the economy gets back on sounder footing. Here's the question, guys, in the comment section. Is Canada's economy becoming more stable? I'd like to know in the comments below. Here's key overnight interest rate. There it is, another little uptick. Bank of Canada's rate should be in 2.5 to 3%, and allowing the banks to make a 2-point spread. It's 2 points off the loan. So that's enough for the banks to make, and then that'll be more than enough for Bank of Canada to take its piece of the pie. Sorry, guys. Lots of pop-ups here. Economists are experiencing a few more rate hikes to come, but the bank hinted on Wednesday that it wants to see how current rates are affecting the economy before proceeding. Let's move on. Economists expect more rate hikes. Candice, a portfolio manager investment firm, Fira Capital, interpreted the bank's statement as clear sign it has strong confidence in the outlook for the economy, which means rate hikes to come. The bank's upbeat tone in the sentiment is not all surprising given the economy is operating near full capacity and core inflation is hovering around target, while trade tensions have receded substantially following the successful renegotiation of NAFTA, she said. So here it is, rates going up, guys. Currency investors were certainly a little bit more confident of more rate hikes to come. Within seconds of news coming out, the loonie gained ½ cent, just under 77 cents US on Wednesday morning. All this being equal, rate hikes send currency higher because they make it more worth your while to invest in the country. That's exactly what it is. The raising rates need to hedge against inflation, and that it's got to be done. It's something that's mandatorily needs to be done. Historical low rates have pushed these bubbles, whether it's the stock market, whether it's the housing market, whether it is even the auto market, where people are, everybody's buying a house, you know, and everybody's buying a car, so everybody on the block has a new car because of rates being historically low and giving money away is what it is. And then now people having to clean up the mess, but who's here to clean the mess up? It's the working poor, and it's the people that don't involve themselves in this whole mess are the ones that are going to have to pay for it. And that's the sad part. Let's move on. 2. RBC, TD, CIBC, and BMO raise prime rates following Bank of Canada interest rate hike. Again, people. Toronto, the cost of loans linked to big bank prime rates are headed higher to the wake of Bank of Canada's decision to raise its key interest rate target by a 1/4 percentage point. That's just a quarter. What if it was back in the 80s, in the early 80s, 1980 or 81, when they raised interest rates to 16%? The Royal Bank of Canada, Bank of Montreal, CIBC, and TD Canada Trust said they are raising their prime rates by a 1/4 percentage point in the wake of the central bank decision. The big four Canadian banks each raised their prime lending rates to 3.9% from 3.7% effective Thursday. The increase rises the cost of loans with interest rates linked to prime rates such as variable rate mortgages and home equity lines of credit. The Bank of Canada, well, you got to also take into account the mortgages that are coming up for renewal. They're going to be going up too, and a lot of them are coming up renewal this third quarter. There's ones coming in renewal first quarter of next year and second quarter of next year. Third quarter, you're going to see tons of renewals, and interest rates are going to be moving up. The Bank of Canada raises about a 1/4 percentage point to 1.75%. It was the 5th time since the summer of 2017 that the central bank has raised the trend-setting rate. Again, let's move on. Rate hikes to cost Canadian households $2,500 each per year, but it isn't uncharted territory, says the report. So this is what it's looking like right now when it comes to raising rates. Canadian debt holders, especially millennials, may see their savings and discretionary spending under pressure as the Bank of Canada announced it would be hiking interest rates to 1.75%, according to Environics analytic study. Canada's central bank raised interest rates by a 1/4 point, marking the 5th time it has done so since the summer of July 2017. Canadian interest rates have remained relatively low since the global recession in 2008. Basically, this is it right here. I brought this article up because I wanted you guys to see this. How much will rate hikes cost you? So in Vancouver, it's going to cost you roughly almost $4,000 a year. Calgary, almost $4,600 a year. Winnipeg, $2,100 a year. Toronto, $3,548 a year. Montreal, $2,048 a year. Halifax, $2,246, and all of Canada as a benchmark whole, roughly $2,523. The people in Vancouver are taking the bigger bite, $3,943, and then Calgary's just followed, and so is Toronto. Toronto's getting a good kick in the butt at $3,548. So I kind of wanted to bring this article up, even though it's the same as the other one, but this one gives you a little bit of a breakdown on where prices are going or where prices are headed when interest rates do go up and what people are paying on the average mortgage. Let's move it on. 1/3 of Canadians feel bankruptcy ahead of expected interest rate hike. What did people believe was going to happen? That interest rates weren't going to go up? That interest rates are going to stay at record lows, historical lows forever? How would the country cope against a devaluing currency? I'm going to head off to the comment section in a second here. Canadians are bracing for another interest rate hike, and many are reporting they fear they are being pushed to the financial brink. It's widely expected that the Bank of Canada will raise the benchmark interest rate Wednesday. We read that part. And younger Canadians appear to be among the most vulnerable with the... Okay, so I'm going on and offline here, guys. Okay, I'm going on and off here, guys. Just hold tight. Younger Canadians appear to be among the most vulnerable, with the Ipsos survey showing 62% of millennials, those aged 18 to 34, are worried about paying their bills, and 46% are concerned about bankruptcy. 46% of young people that are just getting married and settling down. And, yeah, my stream's going on and offline. The survey was conducted between September 10th and September 17, and 2003 Canadians participated. So this is it, guys. This is gonna hurt. 2 words, said Fullerant. United States. So basically, when they have some economic momentum, we follow suit as number 1 trading partner. We kind of follow what they're doing. Oh god, I keep connecting and reconnecting here, guys. Last stream was like that. It kept shutting off, and then I lose a lot of viewers, and then it keeps shutting off and losing viewers, shutting off. So Kevin Thompson has a condo for sale if anybody wants. It's in Oakville, Ontario. If anybody's interested, Kevin Thompson, in the comment section, you could... So this is kind of scaring me, this whole thing. 1/3 of Canadians fear bankruptcy ahead of expected, not unexpected, expected interest rate hikes.
It is expected the Bank of Canada is going to raise its benchmark interest rate tomorrow. If it does, the rate is going to jump from 1.5% to 1.75%.
It will be the 5th increase in just over a year, and many people with mortgages, loans, and other debts are growing concerned. Pat Foran has the results of a new survey on Consumer Alert. Pat.
Michelle and Ken, some Canadians, especially younger ones, feel if interest rates continue to rise, it could cause them serious money problems. 1/3 of those asked are concerned about bankruptcy, and more than half say they're worried about making their payments. The Bank of Canada is expected to push up its benchmark interest rate tomorrow to 1.75%. It's going to make it more expensive to get certain mortgages, car loans, and to...
Do you know what this means, people? Everything I've been saying for the longest time. If the average house was 300,000, then if interest rates do go up 1/4% or 0.5%, it's not that bad when you're borrowing $300,000 to buy a house. Unfortunately, people are paying $1.2 million to buy a house at record low interest rates, and guess what? Your payment's pretty low. But once interest rates need to come up, it's just out of reach for anybody. You know what I'm saying? Yeah, the higher the rates go, the cheaper the inventory gets. That's just plain and simple.